All right, so finally I made it here to talk with my friend Ariel Acosta. We're gonna sit down and do a little bit of questionnaire. It's been a while, man. I've been trying to get to talk to you, sit down with you. You've been busy. I've been busy. Glad to finally do this.
Well, thank you so much for inviting me.
Thank you for the Cuban coffee. I think I'm gonna be pretty energized after this.
Yeah,
How are you, buddy?
great, doing great. Doing
Very
great,
good.
thank you.
Very good. So, just if you don't mind, if you can tell the people watching, tell a little bit about yourself. Where you're from, how you got into this.
All right, my name is Ariel Acosta, and I've been working on the mortgage industry for the last 8, 9 years. I love my job. It's fun, it's busy, it's very stressful, but I enjoy it every second of it.
Perfect, perfect, perfect. Now, as far as the boom is kind of over and everything is shifting, how do you feel? You still got a big workload, or things are slowing down?
I'm not that busy anymore, which I enjoy. So that allows me to take more time to know more the clients. It allows me to enjoy my job more since there is less stress going on.
So, a couple of things I want to talk to you about, and I wanted to get in the first one, which is because of the hurricane and everything happened. And, unfortunately for some people, they ended up without a home. Some folks are have a home but no lights, and it's been destroyed. It's just been terrible. And I know it's going to be a question that a lot of folks are going to be asking: loan forbearance or maybe a payment deferment. Can you talk a little bit about that?
Yes, there are several options that the banks are offering right now. If any person have been affected by the hurricane, feel free to contact your loan service company, and they will help you out to set a payment arrangement, forbearance, of any other kind of arrangement, so you don't get affected and you don't get a hit on your credit and you don't get late payments. Feel free, anybody that is listening or watching this video, feel free to reach out to your lender. They will help you out, and they are reaching out and trying to help. Now, if you haven't been get called, they go ahead and pick up the phone and call them. They will help you out.
So the first thing they need to do is call the lender, not wait.
Don't wait. Don't wait until the payment is due and you're late. That's not a good idea. Be proactive. Call them right away.
This is going to show up on your credit at some point. And the other confusion that I hear a lot of people talk about is misconception, rather. The loan forbearance, some people think that they can just defer the payment and not have to worry about it in the future. But those payments will that balance will need to be paid back, right?
There is no free lunch.
Yeah.
That money, one way or the other, it will be charged. So if you are able to make the payments, don't talk to the banks about delay your payments. You will have to pay it sooner or later. And now you need it, go ahead, call them. And up to today, that's a help that is available. It's right there. Don't hesitate to call them, but don't do it if you don't need to.
So it's something, if it's definitely a hardship, it's the best option for them. But
yeah.
Okay. And then when they do have to pay back, is it usually like a one lump sum, or are they gonna?
There are different ways to pay the money that is being deferred, and every single bank is different. And you should reach out your service company, and they will explain you the different options they have for you, and decide what is best for you and your family.
Okay. Very good. That's pretty informative. The other one that always comes up is pre-qualification versus pre-approvals. That's a really interesting one because we have a lot of banks, online banks. They'll shoot out a pre-qualification to anyone, and then people find out that that's not necessarily a pre-approval, or doesn't hold as much value as a pre-approval does whenever you go and make an offer on a phone, or on a house. So would you tell us the difference between the two?
That is correct. Even the client is able to print out their pre-qualification, and you can go ahead and input on the computer how much money you're making in there. You may get confused, and you may be 1099 and you don't know about it, or you don't know what is your net income, and you go ahead and input incorrect information in there. It is really easy to print out a pre-qualification, but that pre-qualification doesn't take into consideration the review of your documents. It's not a good idea to issue a pre-qualifications. I would love to all my clients to provide the documents. I love to review them and issue an approval letter. That will help the clients to secure a contract better than a pre-qualification.
That's what listing agents look for. Because then you kind of dig in a little deeper. You find out about their finances and see how much really they can really qualify for versus pre-qualification is more like the bank going, all right, I'll take your word for it.
The buyer will be protected by providing the documents. I insist, in my case, I insist on the client to provide all the documents up front.
So there's no surprises later.
Yeah, that way they can close in a couple of weeks versus waiting for 30 days or more.
Okay. The other misconception that I actually come across a lot, and I hear this from a lot of buyers, you'll talk to them on the phone or in person, and they'll be like, I'm waiting to apply. I'm going to pay down some credit cards, and I'm waiting to apply. Because they feel like they want to get some of those things off of, some debt off of their credit, and then they can go ahead and submit the application. Would you talk about that a little bit?
That's a good one. That's a great question, and I love it. I'm glad you're asking about it. We always, as human beings, are trying to do the right thing most of the time, and we're trying to fix what we have been doing wrong. Let's say that we have a collection, and we're trying to make a payment of that collection, or to set in a payment and be debt free. Sometimes, like paying off a debt that is all, it will affect your credit. It will make your credit scores to go down. Don't try to fix it on your own unless you are a professional. Mm-hmm. In my opinion, don't wait until the very last minute to apply either. Even if you are planning to buy next year, go ahead and allow a professional to pull your credit and provide you advice on what to do. Don't go ahead and pay those old debts or, let's say, old medical bills. And I'm not a credit specialist, but in general, if you pay off an old debt, it will affect your credit.
It will. Okay.
It will make your credit scores to go down.
And it makes sense, right? Because you represent the lender, the loan officer, exactly, or anybody else out there, they know exactly what they're looking for. So I think it just makes sense for folks to apply, and then they can see what they need to have done, what needs to be removed, what can stay, for them to get pre-approved, or approved rather.
Yeah, just like in life, you are not an electrician. Don't try to do like electric stuff in your house. It's never a good idea.
Yeah. I've learned the hard way with that.
Yes.
The other thing is, what are some of the common mistakes you see buyers make that can affect their loan approval? Sometimes in the middle of the sale or transaction, they made the offer got accepted. What are some things you see, or even before that they can do that can affect their loan approval chances?
The one major mistake is lack of communication. Why? Because since the buyers are not communicating with the lender or the agent, they do mistakes that simple things. Let's say they have been saving some cash on their kitchen for a year, and they grab $2,000 and go ahead and deposit the money on their bank account. That's a big no. It looks so simple. It's your money. You didn't get it from a wrong place. You just save it.
Yeah.
But it's not a big no. It's not allowed. Don't allow anybody to pull your credit while you're going through a process of obtaining a mortgage.
Like a car loan or
exactly. And sometimes you are having like looking for another job, and you get that offer that you've been waiting for forever.
Yeah.
Like, don't quit your job. Wait until you get your loan on your hands. If you quit your job, that may delay your closing or your loan, or you may get declined as well.
How many times have these things happened to you?
It happens all the time.
Right, sometimes right before closing, right?
Exactly.
You think it's going to happen, and then boom.
Exactly. And something very important as well. Let's say the client is shopping around for furniture because you want some furniture after you close, and you go to Rooms to Go or any other store, and they will let you know, oh, I won't pull your credit. Let me have your name and your date of birth, and they ask you a couple more things. Next thing, they hit your credit, and that may delay your closing, and it may get you declined as well.
You're going to get the couch, but not the house.
Exactly. Don't allow anybody to pull your credit for a car, or furniture, or credit cards, or anything like that.
Okay. What would you say? What would you say is a good credit score, or or actually, let's talk about this first. Credit score versus, debt to income ratio, because a lot of people think that, if my credit score is high, I got the loan. Or some people think, well, my credit score is too low, I don't get the loan. And as you know, that's not always the case. Would you talk a little bit about that?
You may get 580 credit and we can get you approved with that credit scores. And you may have 800 credit and we cannot get you approved. There are so many factors that we have to take into consideration to offer a loan. And go ahead and allow us to do that decision for you. Don't worry. Don't stress out. If you need help, we'll help you out. We'll help you out. But as long as you got 580 credit, you can get approved. Even if you are a few points under 580, we can give you some advice on how to get there.
Okay. And then some of the things that lenders are looking for in the buyer's finance whenever they apply is, so as we talked about, basically stability and employment, okay credit score, not a lot of debt. Is there anything else, any other factors that come into play?
Pretty much the property is very important as well.
So the actual property plays a big role.
Exactly. The client may be approved, but the property is not. So we need all factors to be online in order to close.
Yeah, and that's due to taxes and sometimes HOA fees and so on.
Exactly, and the properties may have issues as well.
True, when it comes to between the FHA and conventional things like that, right?
Exactly. Also, most times we're going to do an appraisal on the property and we need value in there. It doesn't mean that if the value comes under the sales price, it doesn't mean the deal is dead, but the client may have to come with extra money to the closing table to make the closing happen. It's not happening too often right now. It's a really healthy time of the year when it comes to appraised values.
Okay. Well, what do you think is well, I guess you can't really say in your opinion, but from what you've seen, what's a good credit score? You said that 580, you've seen people get approved, but is there like a average that you see, or it's a good credit score for people to have?
It really depends on what loan you're obtaining. If you would like to use down payment assistance, it is recommended to have 640 for most of the programs.
Okay.
There are some of the programs that allow under 640. If you would like to have an FHA loan backed up by the government, by Fannie, by Freddie, Ginnie, by the agencies, then I mean, it's okay to have 580, but if you get to 640, you're going to get a better credit, a better interest rate. You can get better programs. Now, if your credit score goes over 680, you're most likely going to be able to be qualified for a conventional loan, which the conventional loan has mortgage insurance, just like the FHA, but the mortgage insurance will drop in the future on the conventional loan.
But not on an FHA, right?
On FHA, doesn't really fall unless you have put 10% down payment.
Okay.
On conventional, you can close with 0% down if you can. I mean, or 3%. And
perfect world.
Yeah, you get down payment assistance. You don't have to bring any money from your own pockets. In conventional, you still get your mortgage insurance drop in the future once you reach 20% of equity on the property.
So in either case, with FHA and conventional, you've got to be at the 20% equity point for you to.
That is correct. And on FHA, you need to wait 11 years in order for the MI to drop. Actually, for the mortgage insurance, it's called mortgage insurance premium in FHA, and it's called private mortgage insurance in conventional. But it's the same thing, pretty much.
Is there a way to calculate that, or is it just always different, case by case?
On FHA loans, it's really easy to calculate. It's going to be 0.85 factor. And if you put 5% or more, it will be 0.80. And it will be always this amount, these two amounts. On conventional, it's going to change all the time, depending on your credit scores, depending on how much money you're going to put as a down payment.
Okay. Well, since we're on that topic, could you also, if you don't mind, I know you said some things about the FHA and the conventional, I guess to kind of maybe so people know the difference between FHA and conventional, but also the VA and the USDA loan. If you don't mind, can we dive into that a little bit?
Sure thing. VA requires 0% down payment in most cases, unless the client had used their entitlement before, and sometimes they need to bring a little money down payment, but most VAs need to bring zero money to
That's awesome.
as a down payment. That's a great program.
Yeah, yeah.
And FHA requires 3.5% down payment.
Okay.
And in the case of conventional, they do require 3% down payment and up.
And up. Okay. And the USDA, I know we were just talking about that earlier today. Obviously, that's so sometimes rural areas, or most of the times rural areas. So that goes by certain neighborhoods or certain. How does that work? Is that from city to city, or?
Well, there is a map that we can check online, and if the property is eligible, the client needs to bring 0% as a down payment.
That's awesome.
It's a great program.
Yeah. So as long as the property qualifies on the USDA loan, then it'll be 0 down payment.
Correct.
Yeah. And then actually, while also we're on this topic, a lot of times buyers think 0 down payment is 0 money at the closing, which is not so. There's also closing costs, right?
That's not the case. We have closing costs. Closing costs in most cases are 3% of the sales price, and then if you go over $300,000 sales price, it may drop to 2% or so. And yeah, it is. It needs to be somebody needs to bring that money to the closing table. It may be the buyer, it may be the seller. The seller can cooperate up to 3% or 6%.
Okay.
And sometimes on VA loans, they can the seller can help with more than 6%.
That's awesome.
They can pretty much cover all the closing costs.
Really?
Yes.
That's very cool. Well, I'm glad that program is available for the veterans out there. So they'll get the down payment covered, and essentially they could technically get all the closing costs covered and move into the house without bringing any money to closing.
Yeah, they may go to the closing table with bringing 0 money. They may have to provide a deposit that they may or may not get back, but it's a great program. And with this market, there is a chance to ask for closing costs from the seller. So anybody that is a VA out there, don't lose that opportunity.
Yeah, everyone's a little bit nicer now that the market is cooling a bit. Okay. Well, is there anything specific that you would say the buyers or the applicants should look for when they're choosing a lender?
Communication. Again, it is really important. Go ahead and pick up the phone. Make sure that they answer the phone, that your lender answers the phone. Sometimes it's like 6 p.m., 7 p.m., and they're gone for the day. Yeah. Well, try to leave a voicemail and find out if they call you back in the morning.
So how reachable you are.
Exactly. And also, go online. Check their reviews on Zillow. Check their reviews on Facebook, on social media. Google their names. And everybody's these days have reviews.
I just remembered also, while we're on the topic on the closing costs, can you describe just typical closing costs, what people should be looking for? I know that we talked about like the amount that they're going to calculate is how much usually, you said?
It changes a lot depending on the time of the year. Also changes on where the sales price is. If the sales price is under 300,000, you may expect around the closing cost may be around 3% of the sales price. If the sales price over 300,000, it may become 2%, and then in even higher sales price, it may be 1%.
So it might drop with the price.
Exactly.
Okay. Okay. The other thing is, while we're also on that, you've got VA and you've got USDA, the programs that help you get down payment no down payment on the loan. There's another interesting thing, which is the thing we talked about, seller buy down. When the seller buys down the interest rate for the buyers, which is may not be available to some people that aren't on the down payment assistance programs or just conventional. Can you describe that a little bit?
Yes. Interest rates have been going up, and something that can be done to lower the payments is the buy down. There are different kind of buy downs. You can buy the rate, let's say 1% rate for 1 year, or maybe 2, or maybe 3. Usually stop at 3.
Yeah. And
anybody involved on the transaction can pay for that buy down. The seller, the agent, or the buyer.
Okay.
Also, my favorite kind of buy down is buy down the rate for the 30 years or the 15 years. You just buy the rate. Let's say your rate is supposed to be 7%, and you buy it down to 6%. You add to the closing costs when you do so, but you will have a rate that is fixed and it's locked for 30 years or 15 years, and it always will be low, versus if they go up to 3 years, the monthly payment may go up. Now, let's say that you're planning to leave the city in 3 years and you are going to college or somewhere else, or you get a job, you know you're going to get a job in 3 years. Go ahead and do the buy down. Have those 3 years with low monthly payments. And then you don't worry that much about after the year 4 because you will sell the house.
Yeah. Now, I know you don't have your calculator with you, but just maybe to get an idea, let's say whatever amount that 300,000 or 350. If the interest rate, like let's say for example, is 7%, and they were to buy it down to, reasonably speaking, to like what, 6.5 or
Yes.
6.7, what would be the difference monthly in that payment?
Well, let's say like 1 point in 350,000. It may be 250, 300.
Just, I'm sorry to interrupt you. So that people know, what is a point?
A point. Okay, let's say, well, there it may be a little bit confusing. When I'm talking now about buying a point, let's say that you get 7% and you decide to lower the interest rate to 6%. That's 1 full point. Now, when we say buying points is like, let's say like that lowering the rate from 7% to 6.5, it costs 2 points. Those 2 points will be 2% of the loan amount.
2% loan. Okay, so buying points versus points is two different. Okay,
Two different
so
things.
points kind of referring to the actual interest rate. Buying points is what is going to remove off of the interest rate. So it's
Correct.
All right,
Correct.
and you said 2% of the sales price.
Correct.
Okay, that's 1 point. But
Actually, from the loan amount.
from loan amount. I'm sorry. Okay,
Yes.
so the buying point is 2%. One buying point is 2%.
It changes all the time. It
Okay.
changes all the time. So there is not a fixed amount that we can talk about.
So that's something that they need to verify with their
Yeah,
lender.
it changes from client to client,
Oh,
depending
okay,
on
so-
the credit scores, depending
Okay.
on the program, depending on the time of the day, because it may change
Yeah.
from the morning to the afternoon.
And you were talking about the time of the year also, when the taxes are so different. There's a time of the year when taxes are really high. Can you talk about that a little bit?
Yeah, well, when it comes to closing costs, most loans escrow for taxes and insurance through the whole year. And now the insurance is due on the anniversary of the loan. Now, taxes. Taxes are due on November here in Florida. Either title or the client or the service company needs to send a check to the county for the taxes. So let's say you're going to close in August. Title companies need to escrow for a bunch of months, like 12, 13 months of taxes. So you need to bring more money to the closing tables to pay the tax. Let's say you're going to close in December. Title companies will escrow less months on taxes. So you will need to bring less money to the closing tables.
So it all depends on the time of the year as when you buy it.
Correct.
And also, just to clarify for some folks, what is escrow?
Escrow. Well, if the client decides to put 20% down, they have the choice to pay the taxes and insurance on their own once a year, or they can escrow those two, the taxes and the insurance, and you can ask the company, the servicer, the lender, to get from you every month certain amount of money.
Yeah.
The service company will like put all those 12 months worth of taxes and insurance together, and they will send a payment out once per year. They will do it for you.
So the bank's essentially going to just handle it for you.
Exactly.
Okay, makes sense. The other thing is, I guess this is going to be some sort of uncomfortable for some buyers. But what are some of the unrealistic expectations that buyers seem to have, or what they come into the game sometimes not knowing how everything works, and they may expect certain things. Is there anything like that you want to address?
Well, let's put an example. Let's say a client brings a contract, and you ask them for certain documents. Let's say you give them 3 days, 5 days, and they decide they need to take a vacation and go take a whole week out on vacation, and they cannot like sign documents, they cannot send you documents, and then they come back on day 10 and they ask you, hey, what is my approval?
Yeah.
And actually, when you decide to purchase a house, you need to be fully engaged onto the process. and you need to have perfect communication with your lender and with your agent.
Deadlines are very important.
Yes.
Yes.
So they may like feel a little bit more relaxed now that they have a contract and they don't send you the documents and they expect to close on time where they didn't do their homework.
Okay. The other thing I was going to ask you, well, actually, with you and your company, I know it varies. How long does it usually take to close on the loan?
Right now is a good time of the year.
Yeah.
The appraisals are not that busy, so they are not slowing down the process. So we can close in 2 weeks. Now, in most cases, I don't want to stress out the client that much, so I ask for 3 or 4 weeks to close. But if the client's ready, the seller is ready, we can close in 2 weeks.
In 2 weeks, okay. Wow, that's pretty good.
Yeah.
Ask when we were talking about this, as far as the, we talked about the USDA, VA, where they cover the down payment. For the buyers with FHA and conventional, what are some of the down payment assistance programs that are available?
Well, here is the good news. It can be used with any of the programs available, with conventional, with VA,
okay,
with FHA, and with USDA.
Okay.
They are different down payment assistance programs. There are city down payment assistance from the city. For example, from Jacksonville City, there are down payment assistance from Florida, and there are several institutions that help you out, and they like on the national level.
Okay.
The ones I'm a big fan of are the down payment assistance from Florida Housing. Okay. Why? Because they don't slow me down. They don't have extra inspections, and they allow me to close the deal on the same time that I was planning. Let's say in 2 or 3 weeks, they won't slow us down. So
some of them are more strict when it comes to the type of property that you can get into.
Yes, like the city down payment, the down payment assistance from the city, they need to do extra inspections.
Really?
So they really take the sweet time. It takes a while, and they really picky about the quality of the property. They want newer properties. They got to be in a really good shape.
Okay, that makes sense. Well, what are some of the pros and cons of, let's say, using a down payment assistance versus not?
Well, in general, in the past, down payment assistance have a higher interest rate. In this market, that's changing, and sometimes they have better rate than the private market out there. So what I like to do, I like to offer several programs to the clients so they can decide what's best for their family. Okay, awesome. I think that kind of wrapped things up, man. I think we covered a lot of topics here. I know we kind of sped through everything. I'm going to blame the Cuban coffee. I think I'm going to have to get drug tested after this. What was that joke? Where they say, how come Coke never took off in Miami? Yep. Yeah. Yeah, it definitely gets you going. Well, hey, man, thanks. I appreciate you having me in your beautiful home. I thank you for sitting down, taking the time to explain this to everybody. Would you tell folks how they can get in contact with you? All right. So you may call me on my cell phone at 321-460-7261, and my office, 904-528-2128. And the cell, they can call and text, right? Yes. Thank you, buddy. Good seeing you again. Appreciate it. All right. Take care.